Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Polyus' stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Polyus is a gold mining company. It is the largest gold producer in Russia and one of the top 10 gold mining companies around the world. Its main assets are located in Eastern Siberia and the eastern part of Russia. The company produced 2.8 million ounces of gold in 2020. There were only 3 companies in the world that produced more gold: Newmont, Barrick, and AngloGold. It has 104 tons of gold reserves, which is more than any other company. The company is headquartered in Moscow, Russia, and was founded in 1921. It trades on the pink sheets, Deutsche Borse, Boerse-Stuttgart, BATS, Moscow, and London Stock Exchange. Let's get started with the model. This is a large cap company, 22 billion market cap. They're trading at $81 a share, and they have 270 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have lots of free cash flow. It peaks in 2020 at $2.2 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that was the highest in the trailing 12 months at $2.6 billion. Revenue is the sales for the company, and that goes up a ton from $2.9 billion to $5.2 billion. This is the company's income statement. The top line is the revenue, the sales. For your information, all their financials are in US dollars. So you can see their revenue grows nicely year to year. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. All the costs associated with mining and pulling the gold are part of cost of revenue. Revenue minus cost of revenue gives you your gross profit, and that doubled from 2018 to the trailing 12 months. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. An example is the payroll for support functions like HR and marketing. Below that is their operating income, which doubled from 2018 to the trailing 12 months. They spent $201 million of interest on their debt, which is the lowest amount they spent in the past few years. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income, which you can see has grown quite a bit from $500 million to $2.6 billion. This is the company's income statement from their latest quarterly report. The first 9 months of 2020, the first 9 months of 2021, the third quarter of 2020, and the third quarter of 2021. Their revenue did go down a little bit from $1.45 billion to $1.4 billion. They have 6 mining locations, and here's the revenue per mine. The Olympiada is the biggest at $520 million. In the third quarter, they sold 770,000 ounces of gold at a price of $17.87 per ounce. They do have higher revenue in the third quarter because they produce more gold. Their margins were identical though at 60%. Look how good their gross margins are, 68%. Their gross profit was $958 million in the third quarter with $1.4 billion of revenue. The median in the market is 31%, the average is 27%. So you can see how profitable this company is. Let's go back to their income statement. Below revenue is the cost of revenue. So their gross profit did decrease from $1.1 billion to $950 million. They spent $74 million of SG&A, $41 million of other expenses. So their operating profit is down from $948 million to $843 million. The revenue is higher in the first 9 months of 2021 versus the first 9 months of 2020. They spent $45 million of interest on their debt, which is $14 million lower than the third quarter of 2020. The reason their pre-tax income is lower in the third quarter of 2020 compared to the third quarter of 2021 was this $178 million write-down. Below that is their taxes, and the bottom line of the income statement is their net income, which was $664 million compared to $516 million in the third quarter of 2020. And you could see the first 9 months of 2021, it's more than double the first 9 months of 2020. Their net profit margin is 47%, which is unreal. A net profit margin above 20% is really good. Their industry average is only 8%, the median is 1%. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So you can see they're starting to generate over $3 billion of cash flow. Operating cash flow is the cash that's left over after paying all your day-to-day expenses. Since they're a mining company, they have to spend a good amount of money in CapEx. They spent $1 billion in the trailing 12 months. This may include facility improvements, also mining equipment. Operating cash flow minus CapEx give you your free cash flow. And the free cash flow is the cash that's remaining for you, the investor, because the reason people invest in mining companies is for that dividend. Since they're generating a lot more free cash flow than they usually do, they paid down a good amount of debt in 2020. They paid down over $1 billion of debt. In the trailing 12 months, they paid down $300 million of debt. They also bought back stock. They bought back $270 million in 2020, $300 million in trailing 12 months. When a company buys back common stock, it decreases the shares outstanding and makes your shares more valuable. Let's look at their operating cash flows from their quarterly report. This shows us the first 9 months of 2020, the first 9 months of 2021, the third quarter of 2020, and the third quarter of 2021. And the way you calculate operating cash flow, you start with your net income, then you have to add or subtract the non-cash items on the income statement, and then adjust for changes in working capital. So the purpose of operating cash flow is to convert net income from accrual accounting to cash accounting. So we start with the $800 million of net income, and we have to add subtract the non-cash items. The biggest one is depreciation and amortization, almost $100 million. Then we have to adjust for changes in working capital, changes in inventory, changes in receivables. The income statement shows an accounting profit of $803 million, but they actually generated $826 million of cash flow. In the third quarter of 2020, the income statement shows $638 million, but they actually generated $955 million of cash flow. The big difference was that $178 million write-down. That was a non-cash item that brought down their net income, but we have to add it back here on the cash flow from operations section. So you can see how volatile net income is. It was more than double from $1 billion to $2 billion. And it was a lot lower in the third quarter of 2020 compared to the third quarter of 2021. But you could see how smooth cash is. It's very similar, right? You should focus on cash, not so much their accounting profit and loss. Here's their investing and financing sections from their statement of cash flows. The first 9 months of 2020, the first 9 months of 2021, the third quarter of 2020, the third quarter of 2021. They purchased $300 million of property, plant, and equipment. That was most of their cash flow in the third quarter of 2021. In the financing section, they paid down $207 million of debt. They paid $70 million of interest, and dividends are down here. So in their financing section, they had a cash outflow of $381 million. Last year was a cash outflow of $658 million. In the first 9 months of 2020, they paid $430 million of dividend payments. In the first 9 months of 2021, it was $729 million. The reason it was so much higher in 2021 was because gold prices were higher. The higher gold prices are, the more money this company makes and the more dividends they give to their investors. This is the equity section on their 9/30 balance sheet. They have $3 billion of equity. They raised $2.4 billion from selling their business, and they profited $3.8 billion from running their business. And they have negative $3 billion of foreign currency translation reserves, and they bought back $226 million of common stock. The gains and losses from foreign currency translations goes into the equity section of their balance sheet, so they're reporting a $3 billion loss. When the company receives money from other countries, for instance, if they receive US dollars, they have to convert to rubles since they're a Russian company. So it appears their country's currency has done a lot worse than other countries since they're reporting a $3 billion loss. Let's look at their capital structure. $3 billion of equity, $3.4 billion of debt. They're 47% equity, 53% debt. Their net debt is $1.7 billion. That's total debt minus cash. And I gave them the highest WACC of 9.33%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $35 billion. We discounted those numbers back to today using the weighted average cost of capital. we get a value of the company of $30 billion. We divide that by 270 million shares. And we get a calculated stock price of 111. They're trading at 81, so they're trading at a 27% discount. It's a buy according to the model. Their revenue is projected to grow 6.2%, so I grew at 6.2% for the next few years. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed these 4 free cash flow numbers and I divided by the sum of these 4 revenue numbers. And that comes out to 37%, so they convert 37% of their revenue into free cash flow. I multiplied their future revenue estimates by 37%. That's how I got their future free cash flows. Simply Wall Street's valuation is $68, so they're saying it's 19% overvalued. They're in the other direction as me. This is where the stock has been trading the last 5 years. It was trading below $50 through mid-2019. Then from July 2019 to July 2020, it went from 50 to 75. Then in the second half of 2020, it broke through 100, topping about 125. And it traded between 100 and 125 for about a year, but it has come down a little bit lately. This bottom chart is the price of gold. So you can see their stock price pretty much tracks the price of gold. It looks very similar. When you invest in a gold mining company, there's not much magic to predicting the stock price. The stock pretty much moves with the price of gold. It's highly correlated. So the hard part of the equation is figuring out the price of gold. If you can do that, you'd be super rich, because then you could just trade gold. That's why in 2021, the company was paying a generous dividend. Look how high the price of gold was compared to 2020. They pay a semi-annual dividend, and you can see it was $125.87 in 2017. Remember in that chart, the price of gold was fairly low in 2017, 2018, and 2019. It started moving up in 2020, and then it popped in 2021. So you can see they paid their highest dividend in 2021, $261 and $184. So both of their dividend payments in 2021 were higher than their combined dividends in 2017. They pay a nice dividend of 5.5%. Which is 46% of their net income, 57% of their free cash flow. So they can easily afford this dividend. That's why they were able to pay down some debt as well. Their industry pays a 2.6% dividend. They're much higher than their industry, and analysts are forecasting the company to grow their dividend to 6.1%. Their beta is negative 0.05, so the stock moves opposite the market. Gold has always been considered a good hedge against the market. The stock has gone down 23% in the past 52 weeks, while the S&P is up 23%. The 52-week low is 79, the high is 123. And the stock is on a decline, trading well below its 50-day and 200-day moving average. Since this stock trades on the pink sheets, there's not much trading activity, only a few thousand shares per day. Of the 270 million shares outstanding, only 60 million are on float, so it has a low float percentage. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd be really happy today at $65,000. That's a 21% annual return. Private companies own 77% of Polyus, the general public 12.5%, institutions 10%, and insiders 1%. 77% of the company is owned by Wandel Holdings. They own over 100 million shares valued at $8.5 billion. The next is BlackRock at 2.5%, then Invesco, Vanguard, and GQG Partners. Let's look at their financial ratios. They have an amazing PE ratio of 8.5, that's stock price over earnings per share. Price to sales of 4.2, that's stock price over sales per share. And price to book of 7.3, that's stock price over book value per share. Let's look at their non-current assets. 144 million of intangibles, 4.6 billion of property, plant, and equipment, 600 million of inventory, 116 million of deferred tax assets. Deferred tax assets are tax credits that can help reduce your tax bill in the future. They have a really high return on invested capital of 56%. They can cover their interest payments 17 times. ROE of 86%. Their current ratio is 1.8 and quick ratio is 1.3. Let's look at their current assets. 640 million of inventory and 1.7 billion of cash. In the United States, they list assets most liquid to least liquid. But some countries do it the opposite. They list their assets from least liquid to most liquid. Let's look at their current liabilities: $500 million of debt and $820 million of payables. This is how much money Polyus owes other companies. They generated $2.1 billion of free cash flow in the trailing 12 months. They have $1.1 billion of working capital, and they pay out a little over $1.2 billion of dividend payments. So it seems like they're really well funded. They should not need any debt financing to get through the next 12 months. The best way to look at ratios to compare them to companies in the same industry. There are 46 companies in the same industry as Polyus. Polyus spends more in CapEx than the average company. They're more leveraged than the average company. Debt to equity ratio is debt over equity. The higher the company is, the more leveraged, the more debt they have. It looks like they pay the highest dividend of any company in this industry. They generate lots of free cash flow, a lot more than average. They're the fourth largest company on this list in terms of market cap. Newmont is the largest at close to $50 billion. Their price to book is worse than average, but their price to earnings, price to free cash flow are much better than average. Price to sales is a little better than average. They generated $5.2 billion of revenue, which is better than average. And their ROA and ROE are through the roof. So to summarize, I have them trading at a 27% discount. This company flies below the radar. It's not too well known in the investing community, especially in the United States. But if you're looking for a great dividend with stable free cash flow and stable revenue and a growing company, this could be a good investment. I rank their free cash flows 8 out of 10, their revenue 8 out of 10, and their ratios 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you want to get a custom valuation or support the channel through YouTube or on Patreon, you can become a member by clicking on the link in the description below. Thanks for watching.